Well, you're welcome back to the TVC Breakfast show. This is Talktime. Last week, investment bank JP Morgan said it has finally decided to delist Nigeria from its emerging markets government bond index, that's called the GBIEM. Well, at the heart of its decision is the debate over whether to devalue the Naira. Well, the central bank and the Nigerian government see no debate there at all. They're against devaluation, period. Now, the central bank has instead opted to tighten control of the foreign exchange market, keeping the Naira-dollar exchange rate stable. JP Morgan and international investors argue that the Naira needs to be devalued and the foreign exchange completely deregulated. This would allow foreign investors in, but also have negative consequences. A look at the effects a devaluation could have on the economy as compiled by this day newspaper. The Naira could fall drastically to as much as 300 to the dollar. There will be a spike in inflation, which in turn would lead to higher cost of services. The cost of household goods would also rise as manufacturers will be forced to raise prices. There would also be export of local jobs with a rise in production. And on the other hand, Nigeria foreign investors could depart Nigeria as a result of the delisting. I mean, they'll sell their bonds, but we'll come to that. We will come to that. We could lose as much as $2.5 billion in capital outflows. There could also be an increase in borrowing costs, and other indices used to track emerging and frontier equity funds could go the way of JP Morgan. Well, it's like being between the proverbial devil and the deep blue sea. And to help us understand all of this and where Nigeria stands is the head of research at Chapel Hill Denham, Tajuddin Ibrahim. Tajuddin, glad to have you join us on TVC Breakfast Show. Maybe we should start with, for purposes of what you could call the layman out there, because to be very frank, this is one area where, I don't know, well, let me not say that, but you know what I'm getting at. What's bond?
Well, the entire story is around globalization of the Nigerian market.
Yeah, but I want us to get what bond is first, then we'll get into
bond actually is some sort of instrument which we call fixed income instrument, and that instrument attracts what we call coupon, and you know, they are usually issued by the government, and they can also be issued by corporates. And what happens is you get such bonds, you pay for them as an investor, and the moment you pay, you get some sort of promissory note that says, I'll pay to you every 6 months some sort of interest over the period of the maturity of that instrument, which we call bond. The interest that is paid is called coupon. Okay. And usually what we have in this market is semi-annual coupons, which are payable in 6 months. Upon maturity, if the bond we are talking about is a 3-year bond, upon maturity, the bond is redeemed. And the federal government or the state government or a corporate, whoever has issued such an instrument, redeems it and pay back investors their money. That is what is called, you know, basically a bond.
Good, that's beautiful. Now, before JP Morgan Investment Bank delisted, because what they're saying is they're doing it in phases. By the end of September, the first phase will end by 30th October. Nigeria bond will be delisted from the GBIEM. All right, Nigeria was included in this index in October 2012, that you're aware of, alongside South Africa. Now, the basis for the inclusion are this: existence of an active domestic market for FGN bonds supported by a two-way quote system, dedicated market makers, and diverse investors. Do we still have that?
We still have both conditions. We still have a bond market that is priced in that enjoys a two-way quote system, and we still have investors in the market, but largely at this point, local investors.
local investors.
Yes.
Why do we have local investors largely at this point?
At this point, you know, what has happened globally, if you take a look at what has happened to oil prices, what we found is prices have come down. You are aware of that. And that oil price is the major source of revenue for our government. Also, it appears to be like the only source of revenue for us, you know, from a foreign exchange income, from a foreign currency income standpoint. So with that, you will expect foreign investors, you know, that are well educated in this area to be following what is happening to oil prices. So any country where they invest and they notice that the underlying commodity through which the country gets its foreign exchange income is going to suffer, then they will be careful and then gradually be moving their money out of such countries. So that's and Nigeria is one of them.
All right, that's why they're not particularly there now in the numbers that you expect them to be.
Exactly. That's why they're few.
In January 2015, excuse me, JP Morgan placed Nigeria on an index watch before getting to this point. Now it is saying we're removing Nigeria from government bond index by October. They hinge it on operations in forex transactions such as 1, shortage of liquidity, 2, transparency in the determination of the exchange rate, and then 3, lack of fully functional two-way forex market. I want you to explain this.
Let's go a bit further into the financial market.
Okay.
What you have is this. You have an equity market where you have a two-way quote.
Okay.
That is, there are sellers that want to sell at a particular price, and there are buyers that want to buy at a particular price.
That's a two-way quote.
That's what is meant by two-way quote. That is for equity, which we call stocks.
Yeah, stocks.
Secondly, we have a bond market. We have the same set of traders in the market, those that want to buy at a particular price that they will state, and those that want to sell at a particular price that they will say. So we call it bid and offer prices. So those are two-way quotes. The same thing applies to the FX market. In the FX market, you have traders that trade currencies, US dollars, Dutch mark, all sorts, and they state to other trader counterparties, I am selling at this price. The counterparty says, I am buying at this price. That is a two-way quote system. And that is what is obtainable globally. We used to have that in this market previously. But the CBN closed the window. They closed the window about around February, largely because of what they call speculative trading. So when that window became closed, JP Morgan, for example, that deals with all these kind of indices, was much concerned and felt there was need for Nigeria to be removed. Because importantly, what you must watch is any index that they track and has foreign currency attachment, they want a market that has or enjoys a two-way quote system and in which liquidity is pretty good. Those two conditions are no longer obtainable in the forex market at the moment.
Okay, let's get to this. I talked about safety first. Now listen to this. Analysts also believe that had the CBN bowed to the pressure from JP Morgan and other organizations who prefer the safety of portfolio investment, that's what was leading up to. They prefer the safety of portfolio investment to Nigeria's economic stability. Now, the corresponding tension that would have normally followed the erosion of Naira value would have ultimately affected the safety of investment of fund, which the JP Morgan is trying to protect. I want you to respond to that. That was what I was trying to tell you earlier, talk about earlier on.
One key thing we must bear in mind is that there are times that the Nigerian market will enjoy inflows of foreign currencies. And there are also times that they will suffer from an outflow of foreign currencies in the market. What we were looking for at some point is for our market to become a global market, a market that can be accessed by anybody in the entire world. And we gradually got there. Dollars flew into this country because JP Morgan added Nigeria to that index. We enjoyed that period between 2012 up until last year. But because oil prices began to suffer and fall steadily, then they are taking out their money, and Nigeria appears to be suffering for it now. And bear in mind also what is obtainable in the stock market. What happens in the stock market is a situation where foreign investors see attractive valuations. They also see booming oil prices. They see our reserves rising, and they come into the market, bring in dollars into the market, and everybody laughs, and everybody enjoys it. But the moment we have oil prices falling, they want to get out because they know that, number one, our FX reserves are going to fall. Number two, they have a strong feeling that Nigeria will be unable to fund its import bill, and then probably have to devalue its currency. And the moment the currency is devalued, there's what we call carry trade in the financial market. Any instrument that is traded in other currencies outside the underlying currencies upon which it was issued, such instrument enjoys what we call carry trade. Carry trade becomes negative, which is basically the interest or the return that you get on an instrument that is issued in another currency. So carry trade is what JP Morgan is trying to protect here, and that is what all investors, foreign investors, will be looking to protect.
Okay, that's quite interesting. I have this here, so that the removal, when it occurs, will trigger unprecedented sale of Nigerian bonds, capital outflows, and raise cost of borrowing for government. Now, is that true? And then, if that is true, I've also heard that comparatively, that will amount to about $550-something million, and that the Nigerian market has the capability, the investors here, to mop that up. That we have about 2.85 billion or so. I want you to corroborate that or otherwise.
Well, the major thing I think investors, local investors, should bear in mind is that there is no need for panic. The JP Morgan index we are talking about is an index that many foreign investors have really moved their money out of that instrument. What we have in the market at the moment are just a few investors. And if you watch the market, you'll find out that the market responded to this news just one day. The following day, things were back to normal.
Good.
The yield curve, what we call the yield curve, which talks about interest rate and the maturity of a bond that is issued by any corporate or government, it began to come down. But the moment they announced this, the following day we saw a high jump in the yield curve, but that corrected the following day. So, and then the day after, we had normalization in the market. So that speaks to you around the presence of the foreign investors at this moment. They really are not many. And the money we're talking about here, the US dollars we're talking about here, is just less than about $1.5 billion or thereabouts. So investors, I think, to my mind, local investors should not really panic. Many of these foreign investors have gone far before now, and the remainder will just probably leave the market, and then the Nigerian economy should be fine. And what we should also bear in mind is there is need for local investors to participate more in the Nigerian market.